want to bring her in for a deeper conversation on what's happening at Disney. Laura, it's great to see you. I guess there's, the quarter highlights, you've got all these different components to the business. And I guess I would add that Bob Iger's got this activist investor in Nelson Peltz, who's been knocking pretty aggressively on the door. For anybody who's trying to sort of get a sense on where the company's at right now, what was your take on what the company had to say last night?
So I think the sort of key takeaway was cost control and free cash flow generation. So they guided to $8 billion of free cash flow in the fiscal year they just started, this month, because they have a September fiscal. That's double the actual for the fiscal year they just finished. He's going to cut content costs by another $2 billion, and he already saved. He came in at $27 billion of content costs for last year, and it was supposed to be 30, and that's because of the strikes. So he's going to cut him another 2. He's cut out 8,000 headcount, FTEs, full-time equivalents, and that he says he's not going to reverse. So I think the whole story here that's buoying the stock today is free cash flow generation and cost cutting, and cutting those streaming losses. He's cut them by $1 billion over the last 12 months, and he's going to cut those streaming. He said he's going to hit profitability in streaming by the fourth quarter of fiscal, so basically September quarter, a year from now in 24, all of which would allow the EPS of the Walt Disney Company to rise and maybe pay a dividend again.
So that really helps to explain the market reaction. But I think we all know in the time that Bob Iger has been the CEO of this company, he has embraced the idea of a stronger media player. He's been on the offensive for many of those years. Cost cutting is one option, I guess, in the short term. But everybody's now trying to figure out the long term. And Laura, many people have been citing your research for the last couple of years on where Disney goes from here. I will remind our audience that you have had a lot of conviction around the idea that maybe Apple, a longtime partner of Disney, could ultimately be a buyer of this business. Could you explain why you think that could be a possibility?
Sure. So what's happening is that the big fangs, Amazon, Google, Facebook, Apple, have a lot of traffic. But the problem is their average engagement rates, like the minutes or hours, are often very short. Like the average person goes to Google search 5 times a day and spends cumulatively 2 minutes. A great way to increase engagement, it would be seen from Amazon Prime, is you put on a 30-minute episode or a 50-minute episode or a 2-hour movie. So these big conglomerates are really great with their content about keeping engagement, keeping the traffic you have. So Apple has these wonderful devices in everyone's hands. So far, they're only spending $1 billion on content, which means they aren't serious about the content business. But if they decided to get serious about driving engagement length and driving loyalty from consumers, they would then need to buy a content company, because you can't build this stuff. As we know from Netflix, which has been working on this for 10 years, it's really expensive to pay present value dollars rather than just buying a library the way Amazon Prime bought MGM, which was a 50-year library, got them 10,000 hours in the blink of an eye of content. So I would expect Apple then to come to work, because Apple has $90 billion a year of free cash flow, and the Walt Disney Company's entire market cap is $150 billion. So it'd sort of be like a drop in like 2 years worth of free cash flow for Apple to buy it. They can almost write a check for the Walt Disney Company, and it's best-in-class branding, best-in-class characters, it's family-friendly. All of those are brand consistent with Apple, but Apple has to decide that it thinks the content business is worth being in, and to date, they have not done that.
Just a final question, I guess. We'll see if ultimately something that large comes together, but it sounds like something tangible for their ESPN, Disney's ESPN business, could come together sooner, whether that is who knows? Maybe it's something with Apple, but also the possibility that maybe they would find a partner, one of the sports leagues, multiple sports leagues, as part of this, what was very clear last night, this idea of saying we want ESPN to be more digital. What did you make of those comments?
Right. This is the most intriguing thing about the Disney story right now, because Bob Iger, for the first time since ESPN was founded, has broken it out in the profit and in the P&L. So now we know exactly how much ESPN makes in terms of revenue and in terms of profitability. That's interesting. They also confirmed yesterday on the call that they're talking to a number of partners. They've gotten a lot of interest, and they're looking for somebody who could bring an app called ESPN Plus. They want to turn it into the definitive sports streaming app. And so they're looking for partners that might have distribution, might have other sports rights that they don't have, might have marketing advantages that they don't have. So it's all very intriguing who they might bring in as a partner. My gut feel is they'll sell, pick a number, 20, 30% of ESPN now that they're separate financials. And in order to get those services from that partner, my guess is Disney will be the primary runner, like the operator of it. And they said they want that ESPN streaming app, which is not yet best introduced, to be complementary to the linear TV ecosystem, because they make a lot of money, $12 a month for every subscriber in linear TV, whether or not the consumer watches ESPN. So it's a great revenue driver for them, the linear TV ecosystem.
That's great.